to this edition of Mic'd Up. My name's Pete Seyler. I'm part of our business development team here at ICM, and today I'm joined by Mike Paciotti, Chief Investment Officer here at ICM. Mike, thanks for being part of Mic'd Up today.
Glad to be here.
Great. Hey, let's jump right in. In your recent Market Insights letter and in our most recent Market Update webcast, you discussed three potential scenarios for U.S. large cap equities: full mean reversion evaluations, partial mean reversion, and no mean reversion. Each of the scenarios paints a very different picture from what investors have experienced over the last 10 years. So there are two parts to my question here. Historically, what has been the most common outcome? And two, how are things setting up this time around?
Yeah, I mean, it's a great question. In sports, there's a saying that father time is undefeated, right? So eventually, even the greats, Manning, Elway, Marino, Montana, Tom Brady, all of them at some point stopped being superheroes and eventually became mortal again. So I would say the same logic applies here to valuations. Every major market bubble in history, and make no mistake, that's what we're dealing with here, a market bubble, has eventually returned to fair value. And in doing so, and in measuring the performance of the market to that point, valuations are by far the most important factor in creating or destroying wealth for investors. So like the greats, many of them having great late career moments, markets can defy valuations temporarily. However, the pull of that fair value, just like father time, is really hard to resist. It's undefeated, as they say.
So, Mike, what you're describing here really doesn't sound ideal.
You know, I mean, it may not be ideal, but it is normal. And we don't have to really get there all at once. The problem really is that in many cases, while most identify themselves as long-term investors, most don't really mean that. We used to call this getting trapped in the short term, which is really periods of time that are much shorter than an investor's horizon, but much longer than their patience allows them to be wrong, right? So investors who really fit this description, yeah, they're going to have a problem. They're going to have a hard time as they kind of chase the shiny object, as they say. Great bubbles really like to take their time, which is what makes them so dangerous. So for those of us that are really truly long-term investors, right, this isn't really going to be that much of a problem. And for value investors like us, it's really an opportunity for us to have a real impact on outcomes, just like we did last year. So kind of circling back to your original question, what do we expect, right? Eventually, we expect valuations to fully revert to fair value, but I think it would probably take a policy error by the Fed to get us there in the short term, either by tightening too much or not enough, with the not enough really being the greater of the two errors that they could make.
Gotcha. Okay. So, moving forward here, you and the investment team have done a really great job addressing, potential pivot by the Fed. What impact would a pivot have on equities as a whole? But more specifically, what impact could it have on the growth versus value relationship?
Yeah, it's interesting. The real elephant, as they say in the room, is valuations, right? If the market were trading below fair value, much of this wouldn't matter, right? But the broader market is expensive. In fact, if we were to end the bear market here, it would be the most expensive end to a bear market in history at 24 times earnings. Most markets make tops and have valuations that look like this, not bottoms. Now, what happens at the pivot really depends on what the Fed has done before the pivot. In my quarterly letter, I addressed a quote unquote premature pivot. Let's assume that the Fed tightens, twice more, calls it quits, and then immediately pivots to cuts. In that case, I really would expect the economy to still be really strong, right? As we sit right now, the economy is actually requiring 5 million more workers than what we have at the moment.
Yeah, well, I mean, hey, that certainly sounds like the hallmark of a strong environment.
It is, but it's also a sign of excess demand. So as an employer, you don't really require labor if demand is too weak, or really if it's even imbalance. So that economic strength combined with a pivot to cuts would likely send risk assets up, with US stocks gaining, I don't know, maybe 10 or 20%. The dollar would weaken as rates fell. But really, where does that leave you? Once again, you're back at valuations that are stretching historical levels. And the returns that you get from that point forward are going to be in the very low to single digits for quite a while. You essentially start all over from where we were roughly a year ago. Now, when combined with the weakening dollar, it's very likely to restoke inflation. So it's kind of what everyone is wishing for or hoping for at the moment, that we get that pivot. But I wonder if everyone really knows what they're asking for. Now, part two of your question was related to growth and value. So let me just say this, that growth stocks outperformed over the last decade by valuations becoming more expensive, right? Earnings contributed a little bit, but it was mostly valuations getting more expensive that led us to that outperformance, which is ultimately an unsustainable path. So this is yet to really be fully corrected, but ultimately must be before all is said and done with this. So, growth stocks are kind of this wonderful story about the future. The problem is you just can't pay too much for them. And in this case, I really kind of fear that you are paying too much for them.
Makes sense. So if we look at the lay of the land, though, now what if they're too late to pivot?
So if the pivot is too late, the economy is going to feel that strain, right? We're going to get some form of a recession, and it may involve some more losses in the short term, maybe 10, 20% losses from where we are now. But the nice thing about this is a pivot to cuts later will quickly erase that. So that pain that we'll feel by being late is only temporary pain for long-term investors.
All right, that makes sense. And you make a lot of great points here. Do you feel that there's the possibility of any in-between option?
Yeah, it's funny. Usually the in-between is kind of the boring part of any analysis. But in this case, kind of the pause but don't cut option is the really interesting one. So once people realize that there are no cuts coming, the market is really left to trade on fundamentals, right? So earnings in the economy are going to be the key here. Earnings for the S&P appear to be about $176 for the last year, down from about 197 the prior year, roughly an 11% year over year decline. Now, consensus for 2023 is for 13% earnings growth. This is exceptionally optimistic. To create balance in the job market, there needs to be less demand, which is directly linked to earnings. So our expectation is that as the Fed presses down, earnings are going to continue to drift lower, and we may move in the direction of some of those prior lows sometime this year before creating that final bottom later in the year.
Gotcha. So, Mike, last thing, one of our highest conviction assets and one of our favorites has been non-US stocks, specifically emerging markets value. Does any of this have any impact there?
Sure, it does. Yeah. So the end of the rate hike campaign should lead to dollar weakening, in which we've actually already seen the dollar move off of its highs by about 10%, right? That's contributed to the really good start to the year that emerging markets and international have had thus far this year, and even that fourth quarter performance that we saw from them. So you combine that with really a single digit PE for emerging markets, and you have some really interesting potential, not just for this year, but really for the long term.
Great. Mike, as always, it's always great to talk with you. I certainly appreciate your time today, and I'm sure the audience will enjoy your take on things. If any of our advisor partners would like to reach out for more information or with questions, iCM's business development team is here to help. You can connect with us at info@icm-invest.com or by phone at 888-426-4689. And as always, Mike, thanks for joining us, and have a great day.
Glad to do it. Thanks.